Part 5. Cash is King. VanCat's Q1 report looked promising on the surface. Strong sales, rising EBITDA, and steady growth at both locations. But Spencer wasn't smiling. He stood at the bank terminal, staring at the balance. "We're out of cash again," he muttered. "How is that even possible? Didn't we just post a $30,000 EBITDA?" Maria walked in, waving a report. "We did, but remember, we also bought that electric van. That was $70,000, and we fronted $10,000 in inventory for a corporate catering event next month. None of that hits the income statement today." And that was the hard truth. VanCat had positive EBITDA but negative cash flow. Why? The van was a capital expenditure, not an operating expense. It didn't touch EBITDA, but it drained real cash. Inventory and unpaid purchases, changes in working capital, also pulled cash out, even though revenue looked strong. When profit isn't enough, VanCat's not alone. History is full of companies that looked profitable on paper and still went bankrupt. Toys R Us posted positive EBITDA for years, but its debt burden and lack of cash flow made it impossible to invest in its stores or respond to its competitors. WeWork generated massive revenue and showed adjusted EBITDA, but its cash burn rate outpaced funding. It collapsed under its own weight. Back to VanCat. Maria gathered the team. "Our financials look solid, but our cash is tight. That's the reality of growth. Investments today for revenue tomorrow." From that point on, VanCat tracked not just revenue and EBITDA, but actual cash movements, what they spent, when they collected, and what was left in the bank. In this table, we can see that we have our EBITDA of $30,000, which is our starting point. We reduce our change in working capital, which is our inventory buildup and unpaid invoices. We reduce it by our CAPEX, which is the electric van purchase. We reduce any interest paid, and then taxes paid. And then we get to our net operating cash flow. Our takeaway. VanCat's $30,000 EBITDA looked healthy, but cash fell by $54,000 in the quarter. The larger van purchase completely overwhelmed operational performance, showing that even good businesses can run into trouble if cash planning doesn't match growth investments.